what is the price of, so this shows the price of a put on the last day, of a call on the last day. Now, what about an earlier day? Well, the price of a call can never be negative, right? So the call price has to be above this line. It can never be worth less than the stock price minus the exercise price before the, even before the date. And also, it can't be worth more than the stock price itself. I'll draw a 45-degree line from the origin. So it's kind of obvious that that's supposed to be parallel to that. It's obvious that the call price has to be above this broken straight line, but not too far above it. Above this broken straight line representing the price as a function of the stock price on the last day. And the closer you get to the last day, the closer the options price will get to that curve. So on some day before the exercise date, the option price, the call option price will probably look something like that. Right? It's above the broken straight line because of option value. So think of it this way. Suppose an option is out of the money today. Well, we can see out of the money options. This is for a call, this is out of the money, right? Because the stock price is $21.85, but I've got an option to buy it for $25. All right, that's going to be worthless unless the option price goes up before it expires. So it's only worth something because there's a chance that it will be worth something on the exercise date. And what are people paying for that chance? 45 cents. Not much. Why are they paying so little? Well, you could say intuitively, it's because it's pretty far. $21.85 is pretty far from $25. And this option only has a month to go. What's the chances that the price will go up that much? Well, there is a chance, but it's not that big, so I'm only willing to pay 45 cents to buy an option like that. So we're somewhere like here on that row that I've showed you. But the reason you don't want to exercise an option early is because if you exercise it early, your value drops down to the broken straight line. Right? It's always worth more than the broken straight line indicates before the exercise date. So if you want to get your money out, sell the option. Don't exercise it early. So that's why the distinction between European and American options is not as big or as important as you might think at first. So we can just price European options, and then we can infer what other options would be, what put options would be worth. So let's now talk about pricing of options. And the main pricing equation that we're going to use is the Black-Scholes option pricing equation. But before that, I wanted to just give you a simple story of options pricing, just to give you some idea how it works. And then I'm going to not actually derive the Black-Scholes formula, but I'm going to show it to you. But I'm going to tell you a simple story just to give you some intuitive feel about pricing of options. And to simplify the story, I'm going to tell a story about a world in which there's only two possible prices for the underlying stock. That makes it binomial. There's only two things that can happen. And it can either be high or low. All right? So let me get my notation. I'm going to use S as the stock price. All right? And then I'm going to assume that the stock price, that's today. And this is also a simple world in that there's only one day. The option expires tomorrow. There's only one more price we're going to see. So the stock is either going to go up or down. So U is equal to 1 plus the fraction up, that it goes up. U stands for up. And D is down, is 1 plus the fraction down. So that means that the stock price either becomes SU, which means it goes up by a fraction, multiple U, or it is SD, which means it goes down by a multiple D. And that's all we know, okay? But now we have a call option. Call C the price of the call. We're going to try to derive what that is. But we know from our broken straight line analysis, we know what CU is, the price if the stock goes up, and we know what CD is, it's the price if down. Okay? So suppose the option has exercise price E. All right. You understand this world? Simple story. Now, what I want to do is consider a portfolio of both the stock and the option that is riskless. And I'm going to buy a number of options equal to H. H is the hedge ratio, which is the number of shares sold, of shares purchased per option sold. I'm going to sell a call option to hedge the stock price, to reduce the risk of the stock price. Okay, and so hedge ratio is shares sold, shares purchased over options. Each option is to buy one share. Okay, so what I'm going to do is write one call and buy H shares. So let me erase this and start over again. I'm on my way to deriving the option price for you. And it's a little bit of math, but we'll get... Okay. So I'm going to write one call and buy H shares. Okay. If the stock goes up, if we discover we're in an up world next period, my portfolio is worth UHS minus C sub U, right? Because the share price goes from S to US, and I've got H shares, and I've written a call, so I have to pay C sub U. If it's down, then my portfolio is DHS minus C sub D. Okay? This is simple enough. Now what I want to do is eliminate all risk. So that means I want to choose H so that these two numbers are the same. And if I do that, I've got a riskless investment. All right? So set these equal to each other. And that implies something about H. We can derive what H is. If I just put these two equal to each other and solve for H, and I get H equals C sub U minus C sub D all over U minus D S. Okay? So I've been able to put together a portfolio of the stock and the option that has zero risk. It's going to, if I do this, if I hold this amount of shares in my portfolio, I've got a riskless portfolio. So that means that the riskless portfolio has to earn the riskless rate, right? It's the same thing as a riskless rate, so it has to earn that. If I can erase this now, I'm almost there to option pricing. The option pricing then says that since I've derived what H is, the portfolio has to be worth 1 plus the interest rate times what I put in, which is HS minus C. That has to equal the value of the portfolio at the end, which is either U H S minus C sub U or D H S minus C sub D, the same thing. Okay. So I've already derived what H is, and I substitute it into that, and I solve for C. So substitute H in and solve for C. And we get the call price. Okay, and it's kind of a little bit complicated, but I'll write it. The call option price has to equal 1 plus R minus D all over U minus D times C sub U over 1 plus R plus U minus 1 minus R all over U minus D times C sub D all over 1 plus R. And I'll put a box around that because that's our option price formula. Okay? Did you follow all that? This is derived, this option price formula was derived from a no arbitrage condition. Arbitrage in finance means riskless profit opportunity. And the no arbitrage condition says it's never possible to make more than the riskless rate, risklessly. All right? If I could, suppose I had some way, suppose the riskless rate is 5% and I can make 6% risklessly. Then I will borrow at the riskless rate and put it into the 6% opportunity, and I'll do that till kingdom come. There's no limit to how much I'll do that. I'll do it forever. And so it can't, it's too much of a profit opportunity to ever happen. So one of the most powerful insights of theoretical finance is that the no arbitrage condition should hold. It's like saying there are no $10 bills on the pavement. When you walk down the street and you see a $10 bill lying there on the street, your first thought ought to be, are my eyes deceiving me? Because somebody else would have picked it up if it were there. Well, how can it be there? I once actually had that experience. I was walking down the street in New York, and I saw it was actually a $5 bill. It was just lying there on the street. And so I reached down to pick it up, and then suddenly it disappeared. And it was people on one of the stoops of one of these New York townhouses playing a game where they had tied a string to a $5 bill, and they would leave it on the street and watch people reach for it, and they'd snatch it away. That's the only time in my life I ever saw a $5 bill on the pavement. And so, you know, it sounds like a pretty good assumption that if you see one, it isn't real. And that's all this is saying, that if the option price didn't follow this formula, something would be wrong. And so it had better follow this formula. Now, that is the basic core option theory. Now, the interesting thing about this theory is I didn't use the probability of up and the probability of down. So somebody said, wait a minute. My whole intuition about options is I buy an option because it might be in the money. And when I was just describing here, this is 45 cents. I said, that's not much because it probably won't exceed $25. It's so far below it. So it seems like the options should really be fundamentally tied to the probability of success. But it's not here at all. There's no probability in it. You saw me derive it. Was I tricking you? Well, I wasn't. I mean, I tell you, I don't play tricks. This is absolutely right. You don't need to know the probability that it's in the money to price an option. And because you can price it out of pure no arbitrage condition. So that leads me then to the famous formula for options pricing, the Black-Scholes option pricing formula, which looks completely different from that, but it's a kindred because it relies on the same theory. And there it is. This was derived in the late 70s by Fisher Black, or maybe early 70s, by Fisher Black, who was at MIT at the time, I think, but later went to Goldman Sachs, and Myron Scholes, who is now in San Francisco doing very well. I see him at our Chicago Mercantile Exchange meetings. Fisher Black passed away, but so it doesn't have the probability that the option is in the money either, but it looks a little different. It looks totally different from the formula that I wrote over there. The call price is equal to the share price S times N of D1, where D1 is this equation, minus e to the minus r, the interest rate, times time to maturity, T, times the exercise price times N of D2, where this is D2. And the N function is the cumulative normal distribution function. All right. I'm not going to derive all that because it involves what's called the calculus of variations. I don't think most of you have learned that. In ordinary calculus, we have what's called differentials, dy, dx, etc. Those are fixed numbers in ordinary calculus. In the mid-20th century, mathematicians, notably the Japanese mathematician Ito, developed a random version of calculus where dx and dy are random variables. That's called the stochastic calculus. But I'm not going to use that. I'm not going to derive this. But you can see how to price an option using Black-Scholes. But Black-Scholes is derived, again, by the no arbitrage condition, and it doesn't have the probability. Oh, the other variable that's significant here is sigma, which is the standard deviation of the change in the stock price. So once we put that in, someone could say, well, but probabilities are getting in through the back door because this is really a probability-weighted sum of the changes in stock prices. Well, probabilities were not really in here at all, but maybe there's something like standard deviation even in this equation because we had CU and CD, and that gives you some sense of the variability. But I'm going to leave this equation just for you to look at. And, but what it does do is it shows the option price as a nice curvilinear relationship, just like the one I drew by hand, which then as time to exercise goes down, as we get close to the exercise date, that curve eventually coincides with the broken straight line. So now I wanted to tell you about implied volatility. This equation can be used either of two ways. The most normal way to do it, to use this equation, is to get the price that you think is the right price for an option, to decide whether I'm paying too much or too little for an option. So with this formula, I can plug in all the numbers. To use this formula, I have to know what the stock price is, that's S. I have to know what the exercise price is, and I have to know what the time to maturity. These are all specified by the stock price and the contract. I have to know what the interest rate is. And if I also have some idea of the standard deviation of the change in the option, of the stock price, then I can get an option price. But I can also turn it around if I already know what the option is selling for in the market, and I can infer what the implied sigma is, right? Because all the other numbers in the Black-Scholes formula are clear. They're in the newspaper, or they're in the option contract. There's this one hard to pin down variable. What is the variability of the stock price? And so what people often use the Black-Scholes formula to is to invert it and calculate the implied volatility of stock prices. So when call option prices are high, why is that? Why are they high relative to other times? Well, it must be that people think, I'm going back to the old interpretation, that the probability of exercise is high. Right? If an out-of-the-money call is valuable, it must be people think that sigma is high. So let's actually solve for how high that is. I can't actually solve this equation. I have to do it numerically. But I can calculate for any call price, given the stock price, exercise price, time to maturity, and interest rate, I can calculate what volatility would imply that stock price. And so that's where we are with Black-Scholes. So implied volatility is the options market's opinion as to how variable the stock market will be between now and the exercise date. So one thing we can do is compute implied volatility. And I have that here on this chart here. What I have here from 1986 to the present with the blue line is the VIX, VIX, which is computed now by the Chicago Board Options Exchange. When the CBOE was founded, they didn't know how to do this. Black and Scholes invented their equation in response to the founding of the CBOE. And now the CBOE publishes the VIX. And you get on their website. That's where I got this, off their website, cboe.com. And so they have computed, based on the front month option, the near options, what the market thought the volatility, what the options market thought the volatility of the stock market was. That's the blue line. And you can see it had a lot of changes through time. So that means that options prices were revealing something about the volatility of the stock market. Now, the blue line is from the Chicago Board Options Exchange. What I did, and I calculated this myself, is the orange line is the standard deviation of actual stock prices over the preceding year of monthly changes annualized. That's actual volatility, but it's actual past volatility. Let's make it clear what this is. What the VIX is the sigma in the Black-Scholes equation, but it is in effect the market's expected standard deviation of stock prices. And to get it more precise, it's the standard deviation of the S&P 500 stock price index for 1 month multiplied by the square root of 12, because they want to annualize it. It's for the next month. So it's why do they multiply it by the square root of 12? Well, that's because, remember the square root rule. These stock prices are essentially independent of each other month to month. So the standard deviation of the sum of 12 months is going to be a square root of 12 times the standard deviation of 1 month. So, and this is in percent per year. So that means that the implied volatility in 1986 was 20%. And then it shot way up to 60%, unimaginably. In fact, that might be the record high. I can't quite tell from here. Remember I told you the story of the 1987 stock market crash? The stock market fell over 22% in one day. Well, actually, on the S&P, it was only 20%, but a lot in one day. It really spooked the options markets. So the call option prices went way up, thinking that there's some big volatility here. We don't know which way it'll be next. Maybe it'll be up, maybe it'll be down. It pushed the implied volatility temporarily up to a huge level. It came right back down. My actual volatility, now this is, I calculated this for each date as the volatility of the market over the preceding year. Well, since I put October 1987 in my formula, I got a jump up in actual volatility, but not all as big as the options market did. So the option market is looking ahead, and I have no way to look ahead other than to look at the options market. So to get my actual volatility, I was obliged to look at volatility in the past. And it went up because of the 1987 volatility, but not so much. So what this means is that in 1987, people really panicked. They thought something is really going on in the stock market. They didn't know what it was, and they were really worried. And that's why we see this spike in implied volatility. There's a couple other spikes that I've noted. The Asian financial crisis occurred in the mid-1990s. Now, that is something that was primarily Asian, but it got people anxious over here as well. It was, Korea, Taiwan, Indonesia, Hong Kong, these countries had huge turmoil. But it came over here in the form of a sudden spike in expected volatility. People thought things could really happen here. So all the option prices got more valuable. And then there's this spike. This is the one that you remember. This is the financial crisis that occurred in the last few years. Notably, it peaks in the fall of 2008, which was the real crisis when Lehman Brothers collapsed, and it created a crisis all over the world. There was a sharp and sudden, terrible event. And you can see that actual volatility shot up to the highest since 1986 as well at that time. So implied volatility, you can't ask easily from this chart whether it was right or wrong. People were responding to information, and the response felt its way into options prices. There's no way to find out ex post whether they were right to be worried about that, but they were worried about these events, and it led to big jumps in options prices. Now, I wanted to show the same chart going back even further, but I can't do it with options prices because I can show volatility earlier, but I can't show implied volatility before around 1986 because the options markets weren't developed yet. But I computed an actual S&P composite volatility. Well, in my chart title, I said S&P 500. The Standard & Poor 500 stock price index technically starts in 1957, but I've got what they call the Standard & Poor composite back to 1871. And so these are the actual moving standard deviations of stock prices all the way back to the beginnings of the stock market in the US. Well, not the very beginnings, but the earliest that we can get consistent data for on a monthly basis. And you can see, this goes back further than the other chart. You can see that the actual volatility of stock prices has been, except for one big event called the Great Depression of the 1930s, has been remarkably stable, right? The volatility in the late 20th century, early 21st century, is just about exactly the same as the volatility in the 19th century. It's interesting how stable these patterns are. There was this one really anomalous event, and it just sticks out, and that is the Great Depression. 1929 precedes it. It's somewhere in here. But somehow people got really rattled by the 1929 stock market crash. And not just in the US, this is US data, but you'll find this all over the world. It led to a full decade of tremendous stock market volatility around the world that has never been repeated since. The recent financial crisis has the second highest volatility after the Great Depression. This isn't long ago. This is This is well within your memories. It's just a few years ago, we had another huge impact on volatility. And as you saw in the preceding slide, it had a big impact on implied volatility as well. So I think that we had a near miss of another depression. It's really scary what happened in this crisis. What I have also shown here is the first oil crisis, which we talked about in 1974, when oil prices, they'd been locked into a pattern because of the stabilization done by the Texas Railroad Commission. But when that broke, when OPEC first flexed its muscles, it created a sense of new reality, and it caused fear, and it caused a big spike up in volatility of the stock market. But not quite as big as the current financial crisis. So I think this is an interesting chart to me, because it shows that financial markets, well, a lot of things I learned from this chart, and maybe I'll just conclude with some thoughts about this. But what I learned from this chart is that somehow financial markets are very stable for a long time. So it would seem like it wouldn't be that much of an extrapolation. When are you people going to retire? You've picked a retirement date yet? Well, let's say a half century from now, okay? So that'd be 2060, something like that. So you're going to retire out here, all right? Your whole life is in here. What do you think volatility is going to do over that whole period? Well, just judging from the plot, it's probably pretty similar, right? I mean, that's not much more history compared to what we've already seen. Probably just going to keep doing this. But there's this risk of something like this happening again. And we saw a near miss here, but we didn't. I think this plot encourages me to think that maybe outliers or fat tails or black swan events are the big disruptor to economic theory. Black Scholes is not a black swan theory. It assumes normality of distributions. And so it's not always reliable. This leads me to think that option pricing theory, I've presented a theory, the Black Scholes theory is very elegant and a very useful tool, especially useful when things behave normally. But I think one always has to keep in the back of one's mind the risk of sudden major changes like we've seen here.